Welcome to Module 12. In Module 12, Accounting 5000, we're going to finish up Chapter 12, Chapter 6, looking in Module 12 at such things as repairs and maintenance, disposal of assets, leases, intangible assets, and natural resources. So we're going to cover a number of things. A lot of them we'll just talk about. Some of them we'll actually work problems on. So let's start out by talking about repairs and maintenance. There's a difference between repairs and maintenance that we expense and repairs and maintenance that we capitalize. Now by expense, what I mean is that we're going to put it on our income statement and we'll be deducting it in the year in which we actually have that expense. When I talk about capitalizing it, what I'm talking about is that we're going to add it to the value of the asset. In other words, we're going to increase the cost of the asset by the repairs or maintenance that we make that are going to do one of two things. Either increase the salvage value of the asset or extend its useful life. If we make a change to a piece of equipment or a building that we own that's going to increase the life of that building or asset, we capitalize it. We increase the cost of that asset. However, it's just normal maintenance that we do, for example, painting or oil change on a car. Those things are just expense because they do not increase the useful life of the asset in such a manner that it would be something we would want to capitalize. Typically these items are much smaller, and remember our materiality concept from Chapter 2. If it's small and it's really not going to make a difference to an investor or creditor, then we don't usually put anything in the books that would be a capital item. So repairs and maintenance, we draw the line as the things that are just normal recurring expenses that we use to just keep the asset going. And capitalized expenses are those which are going to improve the asset in some way to either increase its life or increase the salvage value of that asset. The second part of this chapter deals with the disposal of an asset, and we talked about that a little bit in the previous module. When we get rid of an asset, that's called disposal of an asset. We can dispose of an asset either during its useful life or at the end of its useful life. And as you remember from that problem we did a few minutes ago in the previous module, we simply look at the net book value and compare that to the amount that we receive. And if the net book value is more than we receive, we have a loss. But if we receive more than net book value, we have a gain. What we do in the accounting side of a disposal of an asset is to remove the asset from our books. Now remember, an asset has a debit balance account balance, so that if we want to decrease it, we're going to credit the asset of equipment or building or whatever we're getting rid of. And we're going to get rid also of the accumulated depreciation related to that asset. Now accumulated depreciation is a contra account to our equipment account or our building asset account. So to get rid of it, we would debit accumulated depreciation for the total amount of depreciation for that asset, and we would credit the equipment or asset account for the amount of the cost of that asset. The gain or loss would be any difference that would result. Remember we talked about the proceeds. If they're greater than book value, it would be a gain. If the proceeds are less than book value, it would be a loss. And we had an example of that in the previous problem in Module 11. The third item we want to talk about in this chapter are leases. And the reason we talk about leases is because they are such an important part of the way a company does business. A lease can be two different things. A first kind of a lease could be just a rental of an asset. For example, you go down and lease a car from a Hertz or a Avis or one of those rental car companies. That lease is just a temporary use. In that case, we would expense that lease. However, if we're going to lease a car for a number of years, that might be a capital lease. So that instead of purchasing a car, you decide to lease it. The key difference there is that in a capital lease, we incur the rights and risk of ownership. So when you see on that slide in front of you it says capital equals ownership, that means that a capital lease means that you incur all the risks and benefits of ownership. In accounting, we've made sort of a rule on how to tell the difference between an operating lease and a capital lease. So if you look there on that third bullet item, underneath are 4 criteria that we use to distinguish between an operating lease, or just a rent, and a capital lease in which you actually have the rights and benefits of ownership. The first thing we look at is, does the lease actually transfer the ownership to the person who is leasing the property? If the answer to that is yes, then it is a capital lease. The second item would be a bargain purchase option. In other words, often in a lease, the person who is actually leasing the asset, or the firm that's leasing the asset, may have the ability to get that asset at the end of the lease term for a very small amount of money. Often if you lease a copier for 3 years and you make payments on it for 3 years, at the end of the 3 years you can actually purchase the copier for $10. Well, that would be a bargain purchase option, because the fair market value of that copier would be more than $10 after 3 years. Sometimes this becomes a judgment call by management and by the accountants as to whether it's a bargain or not. But lots of times it's very obvious, because the bargain purchase option will be very small. Now, if you're talking about leasing a car, in which you lease the car for 3 years and pay a lease payment of about $250, and at the end of the lease you could purchase the car for $16,000, that is not a bargain purchase option. That is simply a rental that you can purchase after the lease life. The third of the 4 criteria is the term of the lease, at least 75% or more of the economic life of the asset. In this case, what you're looking at is, does the life of the lease consume at least 75% of the actual life of the asset? So if you're leasing a car for 3 years and the useful life is 5 years, that's only 60%. In that case, it would not be a capital lease by this criteria. Finally, the 4th criteria for determining whether a lease is a capital lease or an operating lease is to look at the present value of the payments, add them up, and see if they're greater than or equal to 90% or more of the fair market value of that asset. The fair market value would be what you could buy it for in an arm's length transaction at the end of the lease. At the beginning of the lease. So that would be the 4th criteria. If any one of those 4 criteria is a yes, then it's a capital lease. And we will do a problem looking at that in just a minute. But remember those 4 criteria for distinguishing between an operating lease and a capital lease, because how we account for them is different. In an operating lease, we simply debit an expense and credit the cash that we pay for the payment of the lease. In a capital lease, we actually put the asset on our books in our balance sheet. We put the amount of debt that we have related to that asset as a liability account, and we record the depreciation for that asset because we have assumed all the risks and rights of ownership. So it's different accounting methods for different types of leases. So we'll get into that in just a minute. The next item we want to talk about in this chapter are intangible assets. This is an interesting part of a company's balance sheet. If you look at a company's balance sheet and you see several intangible assets, you will see such things as trademarks and copyrights and patents. Those items are assets that don't have a physical substance to them. Intangible means that you can't really touch them. You can't really touch a trademark or touch a patent. But those are things that you have a legal right to, that have a value to them, and they are assets to the company. We do the same thing with intangible assets that we do with tangible assets, in that we take the cost of that intangible asset and allocate it over its useful life as an expense. However, in this type of situation where we have an intangible asset, we call it amortization rather than depreciation. And we don't actually use an accumulated amortization account. What we do is we simply debit amortization expense and credit the asset for whatever amount we use to amortize for that year. So it's a little bit different, but the idea is the same. We write off the cost of that intangible asset over the useful life of that asset. Intangible assets are such things as patents. A patent has a 20-year life. So you take the cost of the patent if you purchased it, or the cost that you had for developing that patent, and you can write it off over up to 20 years, depending on the life of that patent. Trademarks don't have a limited life. Trademarks can last forever as long as they are used. So the company needs to determine what the useful life of that trademark may be. Trademarks typically don't have a useful life that extends indefinitely because companies tend to change their trademarks every few years or so. So they will typically have maybe a 10 or 20-year life on a trademark. A copyright has a useful life of 50 years plus the life of the author. Copyrights are typically given for such things as books and music. So the life of the author of that asset plus 50 years would be the useful life. And again, it's not always the total of those two amounts that you use as the useful life because the asset may not have a real value for that length of time. So the accountants, the managers of the firm, need to determine how long that copyright is actually valuable to them. One of the most interesting intangible assets that you'll find on a company's balance sheet will be goodwill. Goodwill is an interesting concept. Goodwill is the difference between the fair market value of purchasing another company and what you paid for that company. You can only have goodwill if you buy another firm. You cannot generate goodwill internally. You cannot just put it on your books at a whim. You have to actually purchase goodwill. Typically, goodwill comes about because a company has something that's intangible, that is not on their books, that has a value to it. Perhaps they have a very valuable patent, although it's only on their books for a couple of $100s because they developed internally, but it's worth millions of dollars. Or perhaps a trademark. For example, part of the Coke symbol is only worth $1 on their financial statements, but to purchase it, you would purchase it for a lot more than $1. That would be generated goodwill if you purchased the company of Coke. So goodwill is an intangible asset that can only be purchased, and it's the difference between the fair market value of what you buy and what you pay for it. So you can have negative goodwill, although it's very rare. Typically you have very positive goodwill, and again, you do not amortize goodwill. Goodwill is looked at each year to see if it has declined in value, what we call impaired. If something has happened to the goodwill that it needs to be reduced, then you make a journal entry to reduce that goodwill. But you do not amortize it. You used to in the past, but you no longer do that. The last section that we'll talk about in this chapter is natural resources. Natural resources are assets which you purchase that have a value to them, but they're not like equipment or building. There are natural items. For example, a stand of timber, or a coal deposit, or an oil deposit. Those things are of value to a firm. They're an asset, but they aren't like buildings and equipment. So we don't depreciate them. We do something called depletion. It's very similar to depreciation, but it's a little bit more complex, and it's above what we want to do in this particular course. But depletion is the same idea of using up that timber or using up that coal deposit or oil reserve. You can actually deplete more than you actually paid for it. So if you purchased an oil reserve for $1 million, you could actually have depletion of more than $1 million for tax purposes because of the way the tax laws are written. So depletion is similar but not identical to depreciation. But again, it is the writing off of the cost of that asset over time as it produces revenue, so that you can match the expense of that asset with the revenue that it generates. Well, let's look at some problems that demonstrate these different topics that we've talked about so far. And let's start out by looking at problem 12 in your textbook. Problem 12 is on page 218, right about the middle of the book, and it talks about goodwill. It says, goodwill arises when one firm acquires the net assets of another firm, now net assets meaning assets minus liabilities, and pays more for those assets than their current fair market value. Suppose that target company had operating income of $60,000 and net assets with a fair market value of $200,000. Takeover company, another company, decides to pay $300,000 for Target's net assets and business activities. How much goodwill would result? Well, goodwill is the difference between the fair market value of the assets, net assets, and what they're paying for that firm. Well, they're paying $300,000, but the net assets are worth $200,000, so the goodwill would be $100,000. In Part B, it says to calculate the ROI for Target Company based on its present operating income and the fair market value of its net assets. Now, this is before they're purchased. So remember, ROI, back from Chapter 3, is net income divided by average total assets. In this case, our net income is $60,000. Our average total assets are $200,000, which will give us then an ROI of 30%. Now in Part C it says, okay, calculate ROI that takeover company will earn if the net operating income of the acquired assets continues to be $60,000. You're going to use the same calculation. Net income is still going to be $60,000, but notice they paid $300,000 for these net assets. So to compute ROI in Part C, you're going to take the $60,000 and divide it by the $300,000 that they paid for the assets, and you're going to get a 20% return. So by purchasing those assets for more than they were before, you're actually decreasing your ROI. So the final question is the one that would come to mind immediately. What reasons can you think of why a takeover company would be willing to pay $100,000 more than the fair market value of the net assets? Well, there are a number of reasons. One, they do consider a 20% return as an ROI as being pretty good, so they're willing to accept that return. Now remember, goodwill is generated when a company has something that's probably intangible that's worth a lot of money. For example, it could be the location of the firm, it could be the patents, it could be the management of that firm. Those items might not necessarily be on their books, or if they are on their books, they may not be at the value that another firm would put on them. So they're willing to pay a little bit more than the net book value that shows on the balance sheet. In this case, it was $100,000 more, and they may expect to generate more than $60,000 in the future based on those assets. So there would be several situations in which a company would be willing to pay more than the net book value of another firm's assets. So that's a good problem that talks about goodwill. Let's look over at problem 16 and talk a little bit about leases. Problem 16 is in the middle of page 220 of your textbook, and it says that in early January 2003, Telco Inc. acquired a new machine, incurred $10,000 of interest, installation, and overhead costs that should have been capitalized, but they weren't. They were expensed. The company earned net income of $100,000 on average total assets of $800,000 for 2003. Assume the total cost of the new machine will be depreciated over 10 years using the straight line method. The first thing they ask us to do in this problem is to calculate ROI for 2003. Remember, to calculate ROI, we take net income and we divide it by average total assets. They give us net income at $100,000 and average total assets of $800,000. So the way their books read in 2003 would give them an ROI of 12.5%. Now, what would their ROI have been in 2003 if they had actually capitalized the $10,000 and then depreciated the equipment over 10 years? Well, it's going to have that change is going to have an effect on both your net income and your average total assets. Let's figure out why the net income would have gone up $9,000. First, they would not have expensed the $10,000 that they expensed, so their net income would have gone up $10,000, so that would be $110,000. But then they would have had a depreciation expense if they had capitalized that equipment, and since it's a $10,000 piece of equipment with a life of 10 years, that would have been $1,000 of depreciation expense. So you would have the $100,000 net income that was originally shown, plus the $10,000 that they should not have deducted, minus $1,000 of depreciation, so their net income should be $109,000. Now, what about the average total assets? Remember, the average total assets should have been $10,000 more than they're showing up. So instead of $800,000, it should have been $810,000 in one year and $809,000 in the other year. So that would give you then an average total assets of $804,500. If you compute your new ROI then, it would be 13.5% using the 800,000 plus the 809 divided by 2 gives you 804,500 because of your accumulated depreciation reducing your 810 to 809. And then that gives you an ROI of 13.5%. In Part C it says, given your answers to A and B, why would the company want to account for this expenditure as an expense? Well, one of the reasons companies like to expense a lot of stuff is that the deduction reduces the amount of tax they have to pay. So lots of times they will expense as much as they can in order to reduce their tax liability. Another reason they might want to have expensed it is that they wouldn't have had to calculate depreciation on another asset. So that would have saved them some time and some trouble. In letter D it says, assuming the $10,000 is capitalized, what will be the effect on ROI for 2004 and the subsequent years compared to expensing the interest, installation, and overhead costs in 2003? Well, in later years your ROI is going to be lower because your net income will be lower due to depreciation. Your average assets will be higher than the $800,000 because you'll still have additional assets that are showing up, bringing that up over $800,000. So your ROI will be lower for two reasons. Your net income will be lower and your average total assets will be higher. Both of those effects will then decrease the amount of ROI. Okay, that was a good problem dealing with average assets and how that affects ROI. Let's look at problem 23 next. Problem 23 is on the middle of page 223, and this is a lease problem. So let's do a little bit about leases. On January the 1st of 2004, Cary Inc. entered into a non-cancelable lease. They agreed to pay $3,500 at the end of each year for 4 years to buy a new computer system that has a market value of $10,200. The expected useful life of the computer system is also 4 years, and the computer will be depreciated on a straight line basis with no salvage value. The interest rate used by the lessor to determine the annual payments was 14%. Under the terms of the lease, they have the option to purchase the computer for $1 January 1st, 2008, in other words, at the end of the lease. So what you have to do in Part A is explain why the company should account for this lease as a capital lease rather than an operating lease, and it tells you a hint to determine which of the 4 criteria are met. Well, in this case, you know that the second of the 4 criteria will be met. The first criteria is there going to be a change of ownership? We don't really know. It doesn't tell us in the problem. But we do know that the second criteria is met because there is a bargain purchase option in which they can buy it for $1. Well, obviously it's going to be worth more than $1 at the end of the year. So we could stop right there if we wanted to, because you only have to have a yes from any one of those 4 criteria. But just to prove that the rest of the criteria are true, if you look at 3, the lease term is the same, 4 years, as the useful life of 4 years. So that criteria is met. And then we need to look at the present value of the minimum lease payments. And we're not going to discuss how we computed that right now, but the present value of the minimum lease payments is $10,200. So it's the same as the value of the asset. So in reality, 3 of the 4 are yeses. In Part B, it says to write the journal entry that they should make on January 2004. Their hint is first to determine the present value of the lease payments. I'm going to give you that number because we're not ready to compute that until the next module. So that number is $10,200, and on the last line of that slide, I have computed that for you, $3,500 times the number from the present value tables of 2.9137 gives us $10,200, rounding that a little bit. So the entry we make, this is the key to this one, we debit the asset because we're increasing the asset of the computer equipment by the amount, present value of the lease payments, which is $10,200, and we increase the liability we have, that we're going to have to pay for that computer, which we're going to call capital lease liability. You increase the liability with a credit, so we're going to credit that capital lease liability, the $10,200. In Part C, it asks you to make the entry that they would make at the end of December 2004 to record their first payment of $3,500. Well, if they're going to pay $3,500, then you know cash is going to decrease by $3,500. So you're going to reduce cash with a credit of $3,500. So what you have to do next is decide how much of that $3,500 is actually interest on the loan and how much of it is actually going to be the principal payment. How much are you going to pay down on that loan? Well, to figure the interest on the loan, you take the interest rate, which is 14%, and you multiply it by the face amount of the note, which is $10,200. That's your basic old I equals PRT formula. Interest equals the principal of $10,200 times the rate, which is 14%, times the time, which in this case is 1 year, and you get $1,428. Okay, that's the amount of interest you're going to pay. The difference between that and the total $3,500 you're going to pay is the amount that you're going to reduce the lease by, the obligation that you have, in other words, the liability. Well, cash is going to go down because you're paying $3,500. Interest is an expense. To increase an expense, you debit it. So you debit interest expense $1,428. And you're also going to reduce the amount of your liability for that capital lease. To reduce the liability, you debit it. So you're going to debit the capital lease liability by the difference, which is $2,072. In Part D, it says what expenses would be recognized for the lease on the income statement. Well, there are two things that are going to affect the income statement. The interest expense that we just showed you of $1,428 and the depreciation expense for that asset, because remember we put it on our books, so we're going to depreciate it. Let's use straight line depreciation because that's the easiest. We would take the cost, there's zero salvage value, so $10,200 minus 0, divided by the useful life of 4 years, would give us $2,550. So we would have two expenses showing on the income statement. Interest expense of $1,428 and depreciation expense of $2,550. Finally, in Part E, it says, explain why the accounting for an asset acquired under capital lease isn't really any different than the accounting for an asset if it were purchased on a long-term note. There's really no difference because in both instances you're going to put the asset on your books with a debit and you're going to put the liability on your books with a credit. So those two things would be the same no matter whether you had a loan and you were buying the asset or you had a lease and you were purchasing an asset with the capital lease. So there's really no economic difference between the two. Under a note you would debit the asset and credit note payable. Under a lease, you would debit the equipment and you would credit capital lease liability. So they're the same. Same effect on your financial statements whether you purchase the asset with a loan or you lease the asset with a capital lease. So that covers the end of Chapter 6, where we've talked about different kinds of long-term assets, land, building, equipment in part previous to this, and we talked about a number of intangible assets, leases, goodwill, patents, and copyrights in the second part. We're going to continue with the next module, 13, and we're going to use the appendix to Chapter 6 and talk about the time value of money.